Hi everybody, my name's Griffin Bridgers. I'm here today to introduce a new video series that I'm going to launch where we're going to look at, through multiple parts, the basics of the portability election. And we'll even go a little bit beyond basics into some more intermediate strategy around this election, to whom it can apply, where it can apply, and what trickle-down tax effects it might have. Now, this first part, we're really going to launch into the background of portability and how it changed the planning landscape, and that'll give us a little bit better context for the subsequent parts. But before I get started, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, this video series, as I mentioned, is all about the portability election, how we make it, where it applies, to whom it applies, and even who can benefit and in what forms. Now, this is going to be especially important now in the face of some new proposed regulations and some newer regulations from a couple years ago dealing with the clawback of the gift and estate tax applicable credit amount. There's also some added utility here for income tax planning that often flies under the radar, but also coupled with some limitations from a generation skipping transfer tax perspective. So I don't know how many parts this series is going to be, but we're really going to start today with some helpful background and historical context. Now, when portability was enacted, there was a lot of angst among practitioners thinking that this was going to be something that would go away, but as we're going to see, it's now, in effect, it's been there for about 13 years now, or available for almost 13 years, so the chance of it going away is very small. But portability is really simply a colloquial term for a tax election we're going to discuss in greater detail under Code Section 2010C. And this was enacted as part of the Tax Relief Unemployment Insurance Reauthorization and Job Creation Act of 2010. So I want to note that the year of enactment has nothing to do with the code section. They're both 2010, but that's merely a coincidence in the grand scheme of things. But this was enacted on December 17th of 2010, but was given retroactive effect for the decedents who died after December 31 of 2009. And as we're going to see, it created a substantial change to prior planning techniques, and it's helpful to know the scope of those changes. But we're going to note coming up a sunset in the basic exclusion amount that I'm going to define. But at this time, when this was enacted, we were kind of in this weird tax no man's land where on 2001, there had been another tax benefit enacted that was going to sunset. And that was going to be an increase to the applicable exclusion amount that was going to sunset at the end of 2009 into a regime where there was no estate tax, but instead there was a limited basis step up under Code Section 1022. So all throughout 2010, we lived in this weird world where technically that was the law, that there was no estate tax, but there was a limited basis step up. And then at the end of 2010, Obama signed this into law to say that, okay, our new basic exclusion amount is going to be $5 million indexed for inflation, but for decedents who died during 2010, you could elect either the higher exclusion amount with the possibility of a portability election, as we're going to discuss, or alternatively, you could elect no estate tax, but with the limited basis step up under Code Section 1022. That warrants a discussion for another time, but with that background, before portability was enacted, the common theme and application of estate tax planning at death under the basic estate plan revolved around this issue that the applicable exclusion amount, as we knew it at the time, was a use it or lose it tax benefit. Now, that may sound familiar in the face of another sunset I'm going to mention at the end, but ultimately, the economic effect here was if an individual died without enough assets in their name to use their full exclusion, then the unused portion was lost forever. And that's largely still the case for an unmarried individual, but for married couples, this created an issue, especially under more traditional types of setups where one spouse was more moneyed than the other, because order of death usually could not be predicted. So an element of estate planning involved not just the documents, but also asset titling, so that to the greatest extent you could, you would try to equalize the value of each spouse's estate, or ideally make transfers to the less moneyed spouse in at least a sufficient amount to fully use their applicable exclusion amount. But that still wasn't always possible depending on a couple's net worth and their asset mix, and possibly even some other related state law issues. But assuming you could achieve this with a perfect equalization, it meant that regardless of order of death, you could make sure that the unused exclusion of the first spouse to die was maximized. So how did we get there? Well, overall, we had an estate plan common structure at the top of the bell curve, which usually looked at married couples as one estate tax paying unit instead of looking at them individually, which was really the theme under law with this use it or lose it proposition for the applicable exclusion amount. So most of the planning of the time went into what was known as an AB formula planning, which for the first spouse to die used a combination of two different types of trusts potentially, and with those even being split out potentially for generation skipping transfer tax purposes. But for simplicity, we'll look at the two trusts, which were usually one, a credit shelter trust, which was first filled with the remaining exclusion of the first spouse to die. And that remaining exclusion was usually what was left over after making lifetime gifts, because lifetime taxable gifts use the exclusion to offset gift tax before diving into what's left for estate tax. Now, on top of that, if there were more assets than unused exclusion, the balance would then pour over into a marital trust. And that had the effect of, one, avoiding estate tax at first death through the estate tax marital deduction if it was qualified and available, and two, it essentially, for economic purposes, deferred estate tax until the surviving spouse's death, so that at the surviving spouse's death, whatever their applicable exclusion was would offset estate tax on the combination of their estate and the marital trust, or at least the portion of the marital trust that was subject to the estate tax marital deduction at the time of death of the first spouse to die. Now, looking at the marital deduction prior to portability, we had already started to see a shift in the common marital trust structure, but there are still some limitations that we'll talk about. So traditionally, the marital trust was set up in a way where it was a qualifying income interest, which I've talked about in different videos, but coupled with a general power of appointment held by the surviving spouse. That was known as a power of appointment marital trust. However, a shift occurred due to a change under Code Section 2056, which allowed an elective marital deduction under what was known as a QTIP trust, or a qualified terminable interest property trust. So the big difference between the two was that for the power of appointment trust, every dollar of value automatically qualified for the estate tax marital deduction, subject to some other requirements like the QDOT requirement for a non-citizen spouse. But the marital deduction for a QTIP trust required then, and still requires, the filing of a Form 706 to make a QTIP election. But the big difference, as we're going to see later on, is that prior to portability, Rev Proc 2001-38 provided that you could only make a QTIP election to the extent necessary to reduce estate tax liability to zero, because within a QTIP trust, you can make a partial QTIP election to only qualify part of it for the marital deduction. So in a situation, for example, if you didn't have a credit shelter trust, you could make a partial QTIP election to use up the unused exclusion for part of the marital trust, and you still can, but back then, you couldn't overqualify that. You couldn't make a QTIP election for the entire trust, and it wouldn't have made sense to, because that would have caused the loss of exclusion for the first spouse to die. So against this backdrop, in 2010, we had these changes to Code Section 2010, which essentially took an individual tax benefit called the applicable exclusion amount and split it out into two separate and distinct components. One was the basic exclusion amount, which is what we traditionally knew as the applicable exclusion amount, And that is the inflation-adjusted amount that every individual gets to offset both their lifetime and testamentary transfers for gift and estate tax purposes through the applicable credit. But the change in law created now what's known as the deceased spousal unused exclusion amount, which could be preserved for a surviving spouse through an election on a Form 706. We're going to talk more about how we make that election and the mechanics on Form 706, but it's that election that is called the portability election. Essentially, the portability election preserves the deceased spousal unused exclusion amount, or the DSUI, for the surviving spouse. So we can note one requirement there, that you have to have a surviving spouse to begin with. But one key difference from the BEA, the basic exclusion amount, is that the DSUI is not adjusted for inflation. So ultimately, after this change in law was enacted, the applicable credit was based on the sum of the BEA and the DSUI, with some twists, as we'll see, in terms of, one, the ordering between the two as to what applies to the applicable credit, and some other twists that we'll see through this video series. Now, one of the biggest shortcomings of the portability election is that even though there was a change to the gift and estate tax applicable exclusion and applicable credit, there was no corresponding change to the unused GST tax exemption under Code Section 2631C. And this appears to be intentional because this code section was also updated in that same act to note that the GST exemption will be based on the BEA granted under Code Section 2010C. So this isn't an accident. It seems to be intentional that the DSUI doesn't factor into that unused GST exemption. So ultimately, in other words, a better way to state this is that the portability election doesn't preserve a deceased spouse's unused GST exemption. So for GST tax purposes, that continues to be a use it or lose it benefit for all purposes. So I've been mentioning this use it or lose it type of concept, and that has special meaning right now because we used to have this use it or lose it proposition for the applicable exclusion amount at death, and now we're facing one that could even happen during life due to the sunset of the Tax Cuts and Jobs Act of 2017. So effectively, after December 31 of 2025, the BEA will be cut in half. And that reduction will be based on whatever the inflation-adjusted amount of the BEA is as of that date. Now remember, as I mentioned, the BEA continues to be adjusted for inflation, but the DSUI, the deceased spousal unused exclusion, is not. So ultimately, there's this idea the last several years under the planning landscape, especially after those anti-clawback regulations I mentioned, that you could perhaps use the BEA for lifetime gifts prior to December 31 of 2025, or on that date even, to use the 1/2 portion that might ultimately go away. But even after the sunset of the BEA, the DSUI at least should not be affected under current law. So effectively, the DSUI is not going to go away, and you could continue to use it for gifts after that date at a much higher amount than whatever the new cut in half BEA will be. But that will ultimately create some issues for gifting and even income tax planning, as we will see. So what's coming next in this series? Well, we'll dive into how to calculate the DSUI first off, and how to elect to preserve it. And after we look at that basic election, we'll do a little bit deeper dive potentially into the preparation of the 706. I'm not sure if I'll go to that extent yet, but that'll probably bookend this, that we'll look at first how to preserve it, the basics, and then possibly at the end take a deeper dive into the 706. But at the very least, what we'll look at are the valuation elections that you can make on the 706 for portability purposes. We'll also dive into some other questions. One, what happens if the surviving spouse remarries? Does that wipe out the prior DSUI? We'll also look at who qualifies for the DSUI. What are the citizenship and residency requirements for using it? How is it applied, regardless of citizenship or residency status? And we'll dive into the comparison to the norm, that traditional AB planning methods and estate equalization. What benefits and detriments exist when we compare those two approaches. And one element of comparing those two approaches will be the QTIP election. How has that changed, and how does it factor in? And we'll also take a look at the income tax side, because that will come into play, and we'll take a gander at what basis planning implications might exist where we have a DSUI in place. So as always, if you have questions or topic suggestions and you're a tax or estate planning practitioner, you can send those to me at griffin.bridgers@gmail.com, but note that I cannot give tax or legal advice in response to your questions. And if you enjoy this content and you need a speaker for your upcoming group or in-house program, feel free to reach out at my email address I just mentioned as well. But I thank you again for joining me for this video, and I look forward to seeing you in the future installments of this series and in my future content in general.